What is the difference between recourse and non-recourse loans? What is commercial agency debt and community bank lending? And what in the world does debt service coverage ratio mean? In this episode, Kevin Greer, Assistant Vice President of Bank Financial, will give you the answer to these questions and much more. Remember to like and subscribe so we can continue to bring you professionals with awesome information to help you with your multifamily investing career. Enjoy the show. One way that we provide value is by bringing special guests like the one that we have here tonight, Kevin Greer. Kevin is the Assistant Vice President of Commercial Lending for Bank Financial. Kevin is a 25-year veteran mortgage banker and a finance specialist. His skill sets include underwriting, deal structuring, and securing financing, and he has a wealth of knowledge to share in today's markets and commercial lending environment. Kevin, thank you for coming to the show.
Thank you so much again for inviting me, and I appreciate the group, the people that are here and taking the time to come and listen and learn and share.
Kevin, there was a brief introduction that William gave everyone. How about you telling us a little bit more about yourself?
Yeah, absolutely. I've been a lender for over 25 years. I started out as a broker lending from residential lending to fix and flip type deals, purchase rehab, owner occupied deals. I work for several banks here in the Chicagoland area. And currently I'm the EVP with Bank Financial, which is a local regional bank here in Chicago. And we're actually a small bank, but we're publicly traded also. In addition to being a lender, I'm a multifamily investor myself. I currently own a 12-unit here in Chicago, and I'm looking to scale in this market this year to over 100 units.
Nice. And I'm quite certain you'll get to that. So how did you get started in multifamily?
Yeah, that's a great question, Cedric. So like I said, years ago, I used to do fix and flip. I owned a couple of small multifamily rentals, 2 units and 3 units. And then one of my 2 units, I had on the first floor was a senior lady that, was just, she went to work, but she came home and it was just her, right? And then on the second floor of the 2 flat, I had a young lady that had like 3 kids, young kids, like, 2, 3, 4 years old. And so they used to just run around, all evening and just bother the lady on the first floor. So the lady on the first floor would call me and say, Kevin, can you do something about, the noise upstairs? Like every other day. And so finally I just said, you know what, do you want to buy this property? So I ended up selling it to her. And I don't know if she evicted the young lady with the kids, but I'm sure she did. But the bottom line, the reason why I tell that story is because back then, had I stayed in the industry in terms of buying multifamily, the problem is that I had a different mindset back then. I was looking at real estate as tenants and toilets, whereas you have to look at it as a business. It's 100% a business, right? And so had I had a different mindset, I'd be a multi-millionaire today, because that was, over 20 years ago, right? And prices was cheaper and property was cheaper and so forth. That's part of my journey in terms of how I got started. But, I've always been in real estate finance. And so I'm, helping a lot of other people become wealthy in real estate. And so that's part of my journey.
Okay. Kevin, could you explain what are the differences between commercial agency debt and community banking lending?
Yeah, that's a great question, William. So basically, when you hear people talk about agency debt, they essentially are talking about the capital markets, right? So you have what they call government-sponsored agencies, GSCs, and essentially all it is Fannie Mae and Freddie Mac. And what they do is they provide the capital for the private lenders to fund capital markets deals. And those deals are the reason why people gravitate towards those deals, those products, is because those are non-recourse loans. However, they start at $1 million plus. And then there's some other criteria behind it. The community and more regional banks are recourse loans where they can go after you personally. Although you do close an LLC or corporation, it is full recourse where they can go after you personally and take your assets and other other assets and so forth. And then it's a different type of underwriting also. With the capital markets, like I said, they're going to look at your net worth. They have certain net worth requirements in terms of having a net worth of, say you buying $1 million property, then you have to have at least a net worth of $1 million. On top of that, they want to see that you have a certain amount of reserves. It might be 6 months, it might be 3 months, and they're looking at your liquidity, right? That's the agency side. The community bank side or regional bank side is it's a little bit more lenient. I mean, obviously we're going to look at your credit and we're going to look at your reserves, but it's a little bit more lenient in that if you don't have the experience, you can hire a property manager, and that property manager can serve as your experience to get into multifamily purchases.
Okay. So with those differences, what's your opinion as far as dealing with a community bank or a regional bank?
William, I highly, highly recommend that you establish a relationship with the local regional bank in your market, especially if you plan on buying in your market, right, where you live, because smaller regional local banks have to lend money. They have to put money on the street in order for them to generate a return for the bank, for the bank's board and investors. Whereas, Fannie Freddie, the agency, they can kind of raise their rates to turn off the spigot a little bit, right, so to speak. And they can kind of play around with things if they want to if they want to slow down lending, then they will raise the rate, decrease the loan to value, making you having to put more money down, so they can become strict with their underwriting. So I highly 100% recommend establishing a relationship with a local bank or community bank in your region.
With regards to recourse, non-recourse, with Bank Financial, what type of loans do you guys provide to borrowers?
Got it. So what we do is we lend on multifamily, mixed use. That's when you have, the say an apartment above and a retail on the first floor, and commercial retail. So like a strip mall or something like that. We don't lend on single tenant commercial properties where it's just one tenant. So those three are our main bread and butter. We do a lot of multifamily lending, and then after that we do a lot of mixed use.
Within that, are those loans recourse or non-recourse?
Got it. So those are full recourse loans. We close in the LLC, like I said. It does not report to the credit bureau, but they are recourse loans. So if you become delinquent or whatever, the bank will go after you personally. The other advantage that I will mention is of dealing with a community bank, a local regional bank, is, if you get in a situation where you can't pay the mortgage or something like that, then all you have to do is contact the bank, and the bank will work with you. Banks don't want to foreclose. They're not in the business of owning real estate, so they don't want to foreclose on people. And so all you have to do is communicate. They will grant you, well, at least we do. We will grant you whatever, 30, 60, 90-day extension. We will rework the loan. This all type of ways in which we can, work with you.
Well, that's awesome that Bank Financial does that. Could you tell us what are the lending requirements at Bank Financial?
Yeah, so basically the way we structure our deals is a little bit different. So we have two tiers. We have, if someone's buying, like I say, what we call a small multifamily. So what that means is that your loan amount will be under $750,000. We will go up to 80% loan to value. That the rates on that product is slightly higher. It's at I think it's 6.25% or 6.5%. right now. For loans over 750,000 plus, the way we structure our deals is we go up to 80% loan to value, but we do it as what's called a dual note. So we do a first and a second mortgage. The first mortgage, we go up to 65% loan to value. And then the second mortgage, we do it at 15% loan to value. And the reason why we do it this way is because of two reasons. One, it reduces the risk for the bank. And then two, it allows investors to get that higher loan to value of 80%, whereas a lot of banks are pulling back on the loan to value, pulling back to 75 and 70%. Some of them are at 65% loan to value. So we still can go to that higher loan to value under that structure. And then that second, the higher loan amount, that rate right now, as of today, is at 5.95. So we're still under 6%.
Wow.
And we charge no points.
That's really good. Right now being under 6%.
Right.
So what's the maximum loan amount that Bank Financial can service?
For one individual, I mean, we typically go up to about 15, 16 million. Once you get above that, then we have to go to the board of directors for, further scrutiny and approval.
Okay. Let me circle back a little bit. You were just talking about the one product that you have with regards to loan to value. So you're saying it's 70%, and then there's a second of what, 15%, or did you say 10?
Right. So we'll do 65 on the first, and then 15 on the second. That'll get you to 80%.
Okay.
Yeah.
Okay. Now, just one last question with this. So I'm at 80%. Me, the lender, the borrower, I need to bring 20% to closing.
Absolutely.
Now, there's a first and a second already on this. Now, if I had a seller that's willing to do a seller carry, would you guys accept that loan?
We won't allow a seller carryback, because then that changes the whole loan to value situation.
Okay.
If you are going to do something like that, then you probably have to structure it outside of closing. So, and I didn't tell you that.
Gotcha. No, I get it. I know exactly where you're going.
Right.
But that was just something I wanted to throw out there and just get a little clarity on, just in case. But thank you.
Right.
So, Kevin, does Bank Financial service all 50 states?
Currently, we don't. We only, right now, we're in obviously Illinois. We have offices in Texas, Florida, and the Carolinas. So I'm sure we're going to expand, but we have to have like an office there.
Now, on average, with the way that the economy is, how long are you seeing commercial multifamily loans taking the process?
Yeah, that's a good question. I mean, we can close anywhere from 30 to 45 days. Typically, an appraisal takes the longest, usually 2 to 3 weeks. So, if I was putting together a deal, I would probably structure it anywhere from 45 to 60 days. You just never know what's going to happen. If you have, a lot of times sellers are very, very impatient. So 45 days will be a good time frame.
Okay. Of course, right now we hear going back and forth, we're in a recession, we're not in a recession. What does your crystal ball tell us?
Oh man, I wish I did have a crystal ball. But you know what? I don't really too much get caught up into that in terms of recession, non-recession, because you hear it all the time. Some of these economists say we're in a recession. Some say that we're not in a recession. But the bottom line is that, from what I'm hearing, we're headed in that direction, right? And so, you really just have to prepare yourself and underwrite deals a little bit more stricter.
So how much higher do you see the interest rate going?
Well, that's funny. You mentioned that, William. I mean, rates just went up a quarter quarter basis point a couple of weeks ago, right? And there's talk of rates going up again this year. So I think the Fed's meeting again in March, but I would say it's definitely going to be at least one more increase. And then they're going to kind of see how things fall out, stabilize in terms of this economy, in terms of, the recession, the GDP, all of that, unemployment. I think they're going to just kind of try to stabilize. I think we're going to see increase in rate throughout this entire 2023. I know a lot of people say, oh, well, it's going to pull back, but the way it's headed, the way the Feds are talking, it's going to increase.
So has Bank Financial's lending criteria changed in this with the current interest rate hikes?
That's a good question, Shed. I mean, we didn't change our lending criteria. Basically, obviously, we had to raise our rates a little bit, which affects the deal's cash flow and debt service. So a lot of smaller deals are having a tough time qualifying versus the larger property types. The small 6 units, 8 units, those are really coming in tight. So we didn't change the criteria. We just kind of said, okay, the property has to make sure the debt services. We're looking at the condition of the property. That's kind of key. We don't do construction. We don't do major rehab. So we want our properties to be in good condition. So that's something else that we look at.
Okay. You just mentioned something, debt service. Question for you. What is Bank Financial's minimum debt service coverage ratio that you guys look for? And also, can you please explain to our listeners what exactly is debt service coverage ratio?
Yep, that's a great question, Shed. So basically, I mentioned earlier about we have 2 tiers, the under 750,000 and over 750,000. So the deals under 750,000, we call a small loan program. That program, we look for a debt service coverage ratio of 1.20 times. And then over 750, we look for 1.40 times. So for your listeners, the debt service coverage ratio basically is the cash flow of the property, right? We want to make sure that the property will cover the mortgage and provide some cash flow. So essentially, it's the same thing when you buy a house where they look at your debt ratio, right? But with this one, with the debt service coverage ratio, it's strictly the property. So think of it this way. If the debt service coverage ratio is 1 to 1, all that means is that the cash flow from the property, the income from the property covers the expenses, including the mortgage, and it's break even, it's 1 to 1. Once you start rising above 1.1 or 1.0, say you get to 1.2, that means that you are cash flowing 0.2 over, right? So say for even number purposes, that you are cash flowing an extra $200 a month. The higher the debt service, that's the more cash flow to you in your pocket. And so that comes into play with the stronger the property, the stronger the cash flow.
Thank you. That's a great explanation of what it is. Of course, here with this channel, we always want to make sure we educate our people to different acronyms, especially that people utilize.
That was awesome information. Kevin has much more to share in part 2 of this video. If you would like to support this channel, one of the best ways to do that is to like, comment, and subscribe. All those things signal to YouTube that you see value in these videos. Make sure you click that alert bell when you subscribe, and I'll see you in the next episode.